Candle range theory is surprisingly simple, but don't let that fool you. It's one of the most powerful methods I've ever used in trading. What makes it so effective is that it's new. Most traders don't know how to use it properly yet, and that gives you an edge. The win rate with this method is high if you know three things: which candle to choose, where to enter, and exactly where to exit. In this video, I'm going to explain all of it to you in the simplest way possible with real chart examples. To use this method effectively, you should understand two important smart money concepts: market structure and liquidity. We'll go over them briefly, but to make it easier even for beginners, the Flux chart team has created the Price Action Toolkit Indicator, which highlights for you these concepts plus all smart money concepts that you need on a live chart. Let's quickly have an overview of what candle range theory actually is and why it works so well. Consider this bullish candle range. Once it closes at this position, there are only two possible outcomes. At the first scenario, price continues pushing upward, breaking out of the candle's high quickly and closing above the range. When that happens, there's nothing for us to do. The trend is simply continuing, and we move on. In the second scenario, price reverses direction and starts trading inside the range of that bullish candle, eventually breaking out from the low of that candle. And here's the key: this second scenario is not random. It's actually predictable. If you can spot the signs early, you'll know exactly when the price is likely to stay within the candle's range and break lower. And that's the trade setup we're looking for. By recognizing it in a live chart, you can enter at the right moment and profit as the price moves through the range. Let's see some chart examples about it. Consider this candle. First, we identify its high and low. That's the candle's range. Now watch the next candle closely. If it breaks above the range and closes higher, we simply leave it. There's no setup here. The uptrend is just continuing. But if the next candle returns to the range and closes inside it, now we're interested. Take a look. Here, the next candle pushes above the range but then closes back inside. That's our early signal. And see what happens next? The price starts to drop, stays within the range, and eventually breaks below the low of that bullish candle. Perfect trade setup. Now, let's try another example. This bullish candle forms. We mark the high and the low. The next candle breaks above and keeps going. We ignore it. Nothing to do here. That's not our setup. But here's a better one. A bearish candle forms. This time, the next candle doesn't continue down. Instead, it stays within the range and then breaks out from the top. Now, this is interesting. It shows the same pattern but in reverse, because this time the range candle was a bearish candle. And it brings us to this question: how do we actually trade these moves? And more importantly, how do we predict them before they happen? Now, in each example, we're faced with two possible outcomes. The price will either leave the range or it will stay inside and trade within the range. And at first glance, it might seem unpredictable, like we're just guessing which scenario will happen. But here's the twist. Let's bring in something unexpected: the law of non-contradiction, a basic principle from classical Aristotelian logic. It says something can't be both true and false at the same time. So, in trading terms, if the price doesn't leave the range, then by law, it's staying within the range. And when that happens, the candle range trade setup is forming. Plain and simple. That's your signal to pay attention. But why does this matter? Because according to candle range theory, the market always moves through three repeating phases: accumulation, manipulation, and distribution. When price fakes out of the range and then returns back into it, that's the manipulation phase. And that's exactly where smart money leaves its footprint. This is where we should look for lower time frames in order to validate the manipulation by confirming smart money's footprints. And when it happens, this is the golden moment. That's when we look for an entry, because this kind of manipulation is never random. It's engineered by market makers, and if you learn to spot it, you can trade the move before it happens. Now that you understand how the candle range theory works, let's talk about the next crucial step. Which candles should you actually look for to trade? Traditionally, the classic method looks for large range candles that form around key times, like 8 a.m. or 11 a.m. market opens. But let's be real. That approach can be inconsistent. Sometimes it works, other times it doesn't. So I developed my own method, and it's been working extremely well. Here's how I do it. On the 1-hour chart, I first zoom out to understand the market structure. Am I in an uptrend, a downtrend, or stuck in consolidation? Let's explain it with an example. The previous week started strong. The price moved up, then dropped sharply. It closed down at this low. The new week opens at a lower price, moves up a bit, then drops again. But here's the key moment. It touches an order block, and from there the uptrend begins. By studying this structure first, I know exactly what kind of candle range I'm looking for, not just based on time, but based on context. And that makes all the difference. Now let's level up and look at this through the weekly market structure. If the price reaches this previous high and closes above it, that's not just any move. It confirms a break of structure. Take a closer look and you'll see it clearly. We've got a high, a low, and a lower high, which confirms we are already in a downtrend. But this low, this high, and this higher low indicate a new uptrend is forming. And to confirm it, we just need a higher high. And now, this break confirms we will have a higher high than this high. And it confirms a change of character, from a downtrend to a fresh uptrend. Based on structure, we know this candle hasn't broken the last low, which means it's not a reversal. It's a pullback. And from my experience, pullback candles are some of the best opportunities to trade within their range. Why? Because the very next move usually respects their range and trades right through it, or it will leave the range so clear to create a reversal. And that's what we are looking for. We are expecting two scenarios from a range candle: to clearly leave the range or stay within the range, and the pullback candle always does it so well. To truly understand candle range theory, you need to know what a candlestick actually shows you, because every part of the candle tells a story. Each candlestick has two main parts: the body and the wick. Let's start with the body. That's the space between the candle's open and close. If the candlestick shows that the close is higher than the open, it means the candle starts at a lower price and ends at a higher price, so it's a bullish candle. If the candlestick shows that the close is lower than the open, it means the candle starts at a higher price and ends at a lower price, so it's a bearish candle. Now the wick, also known as the shadow, these are the thin lines above and below the body. They show how far the price moved beyond the open and close before the candle finished forming. But here's what most traders miss. The body is where market makers leave their mark. They control the opening and closing. They decide where the candle ends. The wicks, on the other hand, are often retail mistakes: stop hunts, late entries, and emotional trades. All that chaos shows up in the wicks. So when we analyze a candle, we're not just looking at price movement. We're studying who was in control and where the battle happened. That's why, in candle range theory, when analyzing a pullback candle, we pay special attention to the space between the high and the close in a bullish candle, and between the low and close in a bearish candle. That's where manipulation usually happens. So here's what we do. We determine the range of that pullback candle, and this part is key. So when we're analyzing this pullback candle, we focus on the space between the candle's low and its close. That's where the manipulation phase hides, and that's where we should look for entry. So in this pullback candle's range, the manipulation phase hides between this low and this close. That's where the market maker will put its long orders, and we can see these big orders in the form of engulfing patterns or order blocks. Every time I spot a solid pullback candle on the higher time frames, I immediately zoom in to the lower time frames, because that's where the market maker's footsteps become crystal clear. Let's break it down. Right here, on the lower time frame, we can clearly see an engulfing pattern. And just below it, a clean order block that the market already tapped into. That's all the confirmation I need. This tells me that smart money has already made its move. The footprints are there. All we have to do is follow them. Now here's the second order block. To determine these order blocks, I am using a special technique. The first order block is already hit, so the second order block will be a better entry. This is where I'll place my entry. The setup is clean, the logic is sound, and this single trade can easily deliver 50 pips. If you're wondering how I'm spotting these order blocks, or you've struggled to identify them clearly on your charts, just check out the video linked in the top right corner. Just consider it. You cannot trade CRT with usual order blocks. That's why I explained a new step-by-step method about it. It's hard to learn a new method, but don't forget that it's working. Or, if you want to make this whole process even easier, you can use the Flux Chart Price Action Toolkit indicator. Here's how. Open up your chart on TradingView, hit the / key, and search for Flux Chart Price Action Toolkit. To use it 3 days risk-free, use the link in the comment section. Once you add it to your chart, head into the settings. From there, you can fully customize the tool to fit your strategy. Toggle concepts on or off, pick your favorite colors, and keep your chart clean and focused. This indicator is great for analyzing market structure, liquidity, and even smart money footprints like FVG and order block, especially in the lower timeframes. Turn off all the extra ticks, then turn on just 3 key features: order blocks, market structure, and liquidity sides to use in CRT method. When you enable order blocks, the tool doesn't just detect basic zones. It scans the chart and highlights high-probability order blocks, and it shows actual bullish versus bearish volume inside those zones. That's right, you'll see not only the total volume, but also the buyer-seller ratio in percentage, and that helps so much in detecting smart money's footprint. Let's continue with another example. But this one is a bit more advanced. We're clearly in an uptrend, but we've just hit a buy-side liquidity zone at this level. Then this bearish candle forms. While this bearish candle and its next candle stay above this low, we will consider them a pullback move, but reversing from this liquidity level makes it risky. That means we need to slow down and analyze the chart carefully. First, identify this candle's range and mark its manipulation zone. That's the space between the low and the close, just like we covered earlier. Now we go to the lower time frames to search for smart money footprints. On the 30-minute chart, nothing. 15-minute? Still nothing. Even on the 5-minute, there's no clear confirmation. This is where most traders get impatient, but this is exactly when you need to be more cautious, not less. Here's why. This liquidity grab might be the start of a reversal. When we check the lower time frames, we must see the smart money's footprints, some signals that show smart money has executed strong buy orders at this position to stop this downtrend in order to create an uptrend. And when we analyze the lower time frame charts, there was no smart money footprint. Then something is wrong, and it's clear this is not manipulation yet. In this situation, we need to stay cautious and watch the price's next move on the 1-hour chart. And if the price breaks below the range in the 1-hour chart, we need to zoom out to check the higher time frame. Here, you can see that this entire move, made up of several candles, actually forms a single range candle when you zoom out on the 4-hour chart. This is important. When multiple smaller candles create one larger structure, we look for the higher time frames to see it as a single range candle. And when we find one, that must be our new focus. So we determine the 4-hour candle's range, then go back down to the lower time frames to look for smart money footprints. And there it is, a clean order block sitting right where we need it, exactly inside the manipulation range where we expect to see smart money's footprints. That's our entry zone. With this setup, it's realistic to catch a 40-pip move, even from what looked like a messy situation at first. That's it, guys. See you in the next episode.